People should get vaccinated and boosted. At this point, I'm confident that our recovery remains strong and is even quite remarkable when put in context. We should not forget that last winter, there was a risk that our economy was going to slip into a prolonged recession. And there is an alternative reality where right now, millions more people cannot find a job or are losing the roofs over their heads. It's clear that what has separated us from that counterfactual are the bold relief measures Congress has enacted during the crisis: the CARES Act, the Consolidated Appropriations Act, and the American Rescue Plan Act. And it's not just the passage of these laws that has made the difference, but their effective implementation. Treasury, as you know, was tasked with administering a large portion of the relief funds provided by Congress and under those bills. During our last quarterly hearing, I spoke extensively about the state and local relief program, but I wanted to update you on some other measures. First, the American Rescue Plan's expanded child tax credit has been sent out every month since July, putting about $77 billion in the pockets of families of more than 61 million children. Families are using these funds for essential needs like food, and in fact, according to the Census Bureau, food insecurity among families with children dropped 24% after the July payments, which is a profound economic and moral victory for the country. Meanwhile, the Emergency Rental Assistance Program has significantly expanded, providing much-needed assistance to over 2 million households. This assistance has helped keep eviction rates below pre-pandemic levels. This month, we also released guidelines for the $10 billion State Small Business Credit Initiative Program, which will provide targeted lending and investments that will help small businesses grow and create well-paying jobs. As consequential as November was, December promises to be more so. There are two decisions facing Congress that could send our economy in very different directions. The first is the debt limit. I cannot overstate how critical it is that Congress address this issue. America must pay its bills on time and in full. If we do not, we will eviscerate our current recovery. In a matter of days, the majority of Americans would suffer financial pain as critical payments like Social Security checks and military paychecks would not reach their bank accounts, and that would likely be followed by a deep recession. The second action involves the Build Back Better agenda. I applaud the House for passing the bill, and I'm hopeful that the Senate will soon follow. Build Back Better is the right economic decision for many reasons. It will, for example, end the child care crisis in this country, letting parents return to work. These investments, we expect, will lead to a GDP increase over the long term without increasing the national debt or deficit by $1. In fact, the offsets in these bills mean they actually reduce annual deficits over time. Thanks to your work, we have ensured that America will recover from this pandemic. And now with this bill, we have the chance to ensure America thrives in a post-pandemic world. With that, I'm happy to take your questions.
Thank you, Secretary Yellen. Chair Powell, you're recognized. Thank you for joining us.
Thank you, Chairman Brown, Ranking Member Toomey, and other members of the committee for the opportunity to testify today. The economy has continued to strengthen. The rise in Delta variant cases temporarily slowed progress this past summer, restraining previously rapid growth in household and business spending, intensifying supply chain disruptions, and in some cases, keeping people from returning to work or looking for a job. Fiscal and monetary policy and the healthy financial positions of households and businesses continue to support aggregate demand. Recent data suggests that the post-September decline in cases corresponded to a pickup in economic growth. and GDP appears on track to grow about 5% in 2021, the fastest pace in many years. As with overall economic activity, conditions in the labor market have continued to improve. The Delta variant contributed to slower job growth this summer as factors related to the pandemic, such as caregiving needs and fears of the virus, kept some people out of the labor force despite strong demand for workers. Nonetheless, October saw job growth of 531,000 and the unemployment rate fell to 4.6%, indicating a rebound in the pace of labor market improvement. There is still ground to cover to reach maximum employment for both employment and labor force participation, and we expect progress to continue. The economic downturn has not fallen equally, and those least able to shoulder the burden have been the hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. Pandemic-related supply and demand imbalances have contributed to notable price increases in some areas. Supply chain problems have made it difficult for producers to meet strong demand, particularly for goods. Increases in energy prices and rents are also pushing inflation upward. As a result, overall inflation is running well above our 2% longer-run goal, with the PCE price index up 5% over the 12 months ending in October. Most forecasters, including at the Fed, continue to expect that inflation will move down significantly over the next year as supply and demand imbalances abate. It is difficult to predict the persistence and effects of supply constraints, but it now appears that factors pushing inflation upward will linger well into next year. In addition, with the rapid improvement in the labor market, slack is diminishing and wages are rising at a brisk pace. We understand that high inflation imposes significant burdens, especially on those less able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we'll do everything we can to support a full recovery in employment and achieve our price stability goal. Thank you very much.
Thank you, Mr. Chair. Secretary Yellen, thank you for your comments about on the debt ceiling. We have 2 more weeks. We know failing to get this done will hurt families and small businesses and our whole economy. I want to ask you about something else, though. The Wall Street Journal reported 2 weeks ago that 2/3 of the largest publicly traded companies had larger profit margins in 2021 than in 2019 before COVID-19. In 2020, top CEOs made 351 times the income that a typical worker made. Even during an ongoing pandemic, when faced with increased demand and supply chain issues, big corporations refuse to cut their own profits. They raise prices on people. They complain about having to pay workers more, never mind the fact they've been giving themselves raises for years without it impacting their prices. Meanwhile, the costs of housing and medical care and almost everything else for most workers has been rising for years. You've said, Secretary Yellen, you said the bipartisan infrastructure bill and Build Back Better will bring costs down for most Americans. Could you explain that?
Yes. The Build Back Better plan contains support for households to help address some of the most burdensome and most rapidly rising costs that they face. For example, the cost of childcare, which is virtually unaffordable for many American families. There are subsidies for quality childcare that will bring down the cost for the great majority of American families. Universal pre-K for 3- and 4-year-olds. And a child tax credit. And all of that will bring down the cost of child care And for families that are facing crushing burdens, for example, very high rental costs in many areas, the additional money that they get through the child tax credit will help them keep a roof over their families' heads, and as I indicated in my opening remarks, is already helping them put food on the table. With respect to the costs of caring for the elderly, Build Back Better contains support for those who are disabled and the elderly to get care in their homes. There are subsidies, an increase in the Pell Grant, and money for education and for workforce training that will make that more affordable, and reductions in the cost of prescription drugs. These are some of the most burdensome items in family budgets, ones that have risen more rapidly than the general level of prices over time, and the bill will help families meet those burdensome expenditures.
Thank you, Madam Chair. Madam Secretary, Mr. Chair Powell, is it still your belief that higher prices in certain sectors are chiefly caused by the upheaval we're experiencing as a result of the global pandemic, and that as the pandemic eases, so too should inflationary pressure?
So I guess I would say it this way. Generally, the higher prices we're seeing are related to the supply and demand imbalances that can be traced directly back to the pandemic and the reopening of the economy. But it's also the case that price increases have spread much more broadly in the recent few months across the economy, and I think the risk of higher inflation has increased.
Okay, thank you. The dollar is, this is a question for both of you, the dollar is controlled by the American people, but stable coins are controlled by opaque, secretive technology companies over and over on issue after issue. We've seen tech firms put profits ahead of the public interest with our elections, with our privacy, with competition in our markets. Is it risky, and start with you, Madam Secretary, is it risky to let control over our money fall into the hands of these companies?
I believe that stable coins can result in some greater efficiencies in the payment system and could contribute to easier and more efficient payments, but only if they're adequately regulated. And the President's working group that I chair recently issued a report indicating that there are significant risks associated with these currencies, risks to the payment system, risks of runs, and risks related to the concentration of economic power. And we have called upon Congress to put in place for these stable coins a regulatory framework that would make them safe and protect consumers and put them on a level playing field with other providers of similar services, such as banks.
Chair Powell, do you agree with that?
Yes, I do.
Okay, thank you. In closing out my time, I think it's important to look at a bit of historical perspective, as both of you have explained to me in other conversations. In the late 90s and early 2000s, over-the-counter derivatives and subprime mortgages were billed as financial innovations. Financial regulators at the time pushed to weaken safeguards, saying that a cloud of legal uncertainty hung over the OTC derivatives markets, and regulations, again, their words, could discourage innovation and growth and drive transactions offshore. Later, the banking lobby argued that regulating subprime mortgages would decrease borrower choice and reduce access to capital. The Financial Crisis Inquiry Commission cited derivatives and subprime mortgages as key factors in the crisis. It looks again like the financial industry uses these same arguments for stable coins in decentralized finance platforms. Today, all of us on this committee in both parties should be concerned about that, should understand the historical parallels, and should listen to this very bipartisan panel. The Secretary of the Treasury and the Chair of the Federal Reserve. Senator Toomey.
Thank you, Mr. Chairman. Since the topic of the debt ceiling came out, let me just remind all of us of something that we know very well, and that is our Democratic colleagues can raise the debt limit all by themselves anytime they want, and there's nothing Republicans could do to stop them. The tools have been available to them all year long, and in fact, Republicans have offered to expedite the process. There is only one reason that our Democratic colleagues refuse to use reconciliation to raise the debt limit. And that is because they would have to specify the amount of debt they want to inflict on the American economy. They want to avoid accountability for this terrible spending spree they're engaged in by obfuscating and not specifying a dollar amount. I think we should be very clear about what's going on here. Mr. Powell, under the Fed's new flexible average inflation targeting, the inflation target remains at 2%, but now it's on an average over an unspecified time frame. Core PCE, the Fed's preferred inflation metric, is running about above 2% over the past 5 years, nearly 3% over the past 2 years, and 4.1% over the past year. So it's above target. It has been above target, and it's accelerating. And yet the Fed has maintained an extraordinary emergency monetary policy stance. Looks to me like this framework appears to be a weakening of the Fed's commitment to stable prices. Now, I know you believe this is transitory, but everything's transitory. Life is transitory. How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Well, first of all, the test that we've articulated, I think, clearly has been met now. You're absolutely right. Inflation has run well above 2% for long enough that if you look back a few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this episode. It had been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Well, it still strikes me as just extraordinary that the economy it's long past recovery. We're in a full-blown expansion. Unemployment's down to 4.6. We have record high asset prices. Housing is leading the way to the point where in many markets, houses are just unaffordable for many people. And yet, the Fed's going to purchase $35 billion in mortgage-backed securities in December alone, and scheduled to continue purchasing mortgage-backed securities for months on end. I would strongly urge you to reconsider the pace of the tapering. Secretary Yellen, I want to follow up on the discussion about payment stablecoins. In the President's Working Group, payment stablecoins were defined. And the definition is, and I quote, "Those stablecoins that are designed to maintain a stable value relative to a fiat currency and therefore have the potential to be used as a widespread means of payment," end quote. Well, that certainly covers every major stablecoin that exists right now. And what strikes me as perplexing is that the President's Working Group recommendation is that all such stablecoins be required to be issued by depository institutions only. But yet, as you know, the mechanism by which the value of the stablecoin is maintained relative to a fiat currency, they vary significantly. Some arguably look somewhat like depository institutions. Others look much more like money market accounts. Still others look like something wholly new. Why suggest that they all must be regulated the same way and treated as depository institutions?
Well, they all have the potential to be used as a means of payment, regardless of how they are used at the outset when they're introduced. And the structure that they espouse and adhere to, which is that they have a stable value relative to a fiat currency, that is really what depository institutions guarantee.
I would just suggest that we really think this through. I think the very fundamentally different designs suggest that there might be different regulatory approaches. I'm going to run out of time here. So, Mr. Chairman, I just want to note that Pillar 1 of the Biden administration's international tax agreement will be the most significant international tax change in 100 years. To implement it, every one of our bilateral our bilateral tax treaties would need to be modified. There is no historical precedent for bypassing the Senate treaty process to implement Pillar 1. Secretary Yellen, during a recent Finance Committee briefing, I asked you to acknowledge that administration would need to come to the Senate for treaty approval to implement Pillar 1. You responded that Treasury has yet to determine whether a treaty will be needed or not. In my view, and that of many of my colleagues, implementing Pillar 1 would require modifications to our existing bilateral tax treaties, and those modifications must be approved by 2/3 of the Senate. The executive branch cannot ignore the Senate on a matter that is clearly our constitutional responsibility. Thank you, Mr. Chairman.
Thanks, Senator. Senator Reid is recognized from Rhode Island.
Thank you, Mr. Chairman. And first, let me thank Secretary Yellen for being our guest speaker at the Providence Chamber of Commerce last week. Thank you, Madam Secretary.
Thank you.
And I learned something there. I always do when I'm with the Secretary. She is the only person that has been chairman of the President's Council on Economic Advisors, chairman of the Federal Reserve, and Secretary of the Treasury. So thank you, Madam Secretary, for your work. And let me, Chairman Powell, extend my congratulations for your reappointment to the Federal Reserve. Thank you. Chairman Powell, we've seen, as you both discussed, a steady job growth. What is troubling, though, is the labor participation rate has remained depressed. And until we get that participation rate up higher, we're going to have the complaints that we receive, the inability to get workers, et cetera. How do we do that? And what do you think are the causes of this fall off in the participation rate?
I didn't catch the very end of that.
The causes of the fall in the participation rate, and then how do we rectify those causes?
So it's very surprising. Since June of last year, the unemployment rate has dropped 6.5%, and participation has basically moved up to 0.2. It's sort of moved sideways, which was surprising. I think when unemployment insurance, enhanced unemployment insurance ran off, and schools reopened, and vaccination came, we all thought there would be a significant increase in labor supply, and it hasn't happened. So you ask why. There's tremendous uncertainty around that, but a big part of it is clearly linked to the ongoing pandemic. People answer surveys, and they're reluctant to go back to work. They're reluctant to leave their caregiving responsibilities and go back to work because they feel like schools might be closing again, things like that. So it's an issue, and I think what I'm taking on board is that it's going to take longer to get labor force participation back. We're not going right back to the same economy, and really, it's going to take. Often, labor force participation is a lagging indicator. It follows big improvements in the unemployment rate, and we're probably on track to have that happen. And that means to get back to the kind of great labor market we had before the pandemic, we're going to need a long expansion. To get that, we're going to need price stability, and in a sense, the risk of persistent high inflation is also a major risk to getting back to such a labor market.
Thank you very much. Madam Secretary, let me thank you for your maximizing the flexibility in the Emergency Rental Assistance Program. Steps like self-attestation and bulk utility payments have been very helpful to Rhode Islanders trying to get these returns. One area, though, is very difficult, and it always seems difficult. That is the homeless population. Can you look at and try to develop the ERA guidelines to emphasize how funds can be appropriately used for homelessness?
That's an extremely important area. We're very focused on it, and we'll be happy to work with you on it. What I can say is that ERA funds can be used to provide so-called housing stability services, a range of services to the homeless to help them find a stable shelter. Something that Treasury did, a kind of flexibility that we built into our guidelines, is ERA statute requires that to be eligible for assistance, a household has to have a so-called rental obligation. Recognizing that would be something that would be challenging for families experiencing homelessness, we created an opportunity for ERA grantees to provide individuals with a letter of intent to pay a rental obligation. So with this letter of intent, that would make it easier for the homeless to be able to secure housing. So those are two forms of flexibility we think will help, and would be glad to work with you to see if we can identify more.
Thank you, Madam Secretary. And on communicating those provisions to local authorities would be helpful. And just a final point, Secretary Yellen, this is with the Homeowner Assistance Fund. I know you're looking at the state plans, and if you could accelerate that to get the money out, because as you well know, a lot of these moratoriums on eviction are either gone or going, and it would be very helpful to get the money out. Thank you.
Yes.
Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Crapo of Idaho is recognized.
Thank you, Mr. Chairman. Secretary Yellen, some appear to believe that you have announced that unless a debt limit increase or suspension occurs before December 15th, that the Treasury faces imminent default. That's not how I've read your comments. So it would be helpful for you to clarify what your current projection is for when Treasury would run out of headroom to operate below the debt limit and run dangerously low of operating cash. I also request that Treasury provide details of its latest debt and cash projections to the Finance Committee, and look forward to receiving those projections.
Yes, let me clarify what I said. What I indicated in my most recent letter to Congress is that I have a high degree of confidence the Treasury will be able to finance the U.S. government through December 15th, but there would be scenarios in which Treasury would not have sufficient funds to continue to finance the operations of the U.S. government beyond that date. I would note that on December 15th, Treasury will invest funds from the infrastructure bill, and that will use up $118 billion worth of capacity when those funds are from the Highway Trust Fund are invested in government securities. And I didn't say that there is no way that we can make it past December 15th. There are a range. There's uncertainty about what our cash balance will be and our resources. Right now, there is uncertainty about where we will be on December 15th. And there are scenarios in which we can see it would not be possible to finance the government. That doesn't mean that there are not also scenarios in which we can, but we think it's important for Congress to recognize that we may not be able to, and therefore to raise the debt ceiling expeditiously.
Well, thank you for that. Thank you for that clarification. Chair Powell, inflation hit 6.2% last month, which is the highest in more than 3 decades. Still, the administration is pushing for support of a nearly $2 trillion social spending package. And by the way, that number even accepts their budget gimmicks that hide real costs that could mean several trillion more in spending over the next 10 years. Most of that spending does nothing to ameliorate the problems of rising inflation. In fact, will simply add fuel to the inflation fire. I'm very concerned that the administration is not taking inflation's threat seriously, and in the case of energy prices, is enacting regulatory policies that themselves are threats. Do you agree that inflation is a serious threat to our economy, and how do you intend to address inflation? I do think that the threat of persistently higher inflation has grown. I think my baseline expectation is still, as I mentioned, and of most forecasters, is still that inflation will move back down over the course of next year, closer to our target. But clearly, the risk of more persistent inflation has risen, and I think what you've seen is you've seen our policy adapt. And you'll see it continue to adapt. We will use our tools to make sure that higher inflation does not become entrenched.
I noted in your opening statement that you indicated that inflation pressures will linger well into next year. You do stand by that?
Yes, I think we can now see certainly through the middle of next year. It's an expectation. We're forecasting is not a perfect art, as you may have noticed. But yes, right into the middle of next year, and that's our expectation. But of course, what's happened is that date has been pushed out repeatedly as supply side problems have not really improved.
And if Congress were to pass an additional $2 trillion plus in spending, mixed with a number of increases in taxes, would that add to inflationary pressures?
Senator, I'm sorry I'll just note that we have a longstanding policy of not commenting on active legislation, as you probably aren't surprised to hear.
I suspected that. One last very quick question, and for you, Chair Powell, you've indicated that there would be a report by the Fed on its discussion paper relating to digital currencies, and that's been delayed several times. My question to you is, when can we expect the Fed's report, and are there reasons for that delay?
I would think very soon. It's certainly in coming weeks. And, the reasons are just trying to get it right and trying to find the time to get it right. It's been a very busy time, as you will know.
Thank you.
Thank you.
Thanks, Senator Kraft. Senator Warner, Virginia is recognized.
Thank you, Mr. Chairman, and good to see you, Secretary Yellen, and congratulations, Chair Powell, on your reappointment. I want to start with you, Chair Powell. I actually think the Fed's activities, particularly during the pandemic, which included both extensive use of 13.3 facilities and some aggressive bond purchases, actually helped stave off what could have been a complete economic meltdown. And while we did spend in excess of $5 trillion, mostly all in an extraordinarily bipartisan way under both President Trump and President Biden on recovery from COVID, I think history will treat those actions, certain areas, excessive. But I think net, from a historical perspective, it'll be well regarded both for the American economy and for the world's economy. But I think, as you've indicated, Chair Powell, I think we're seeing our economy come back. We will differ on the bipartisan infrastructure plan and maybe even a bit of the Build Back Better, but that's part of our job. But I have seen since your FOMC's November meeting that the Fed signaled a shift, announcing starting to move back from some of the very aggressive means you've used and announcing a tapering on the pace of bond purchases month by month as the economy continues to strengthen. I'd like you to get into that a little bit. Which factors most influence that decision for a gradual change in course, and how long do you think it'll take the Fed to gradually wind down these purchases?
So we actually haven't made a decision on that, but I would just say this. The most recent data, particularly since the November FOMC meeting, show elevated inflation pressures, a rapid improvement in many labor market indicators without an accompanying addition of labor supply, and also strong spending that really signals growth, significant growth in coming months. Remember that every dollar of asset purchases actually adds accommodation to the economy. But at this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And I expect that we will discuss that at our upcoming meeting in a couple of weeks. Of course, between now and then, we will see another labor market report, another inflation report, and we'll also get a better sense of the new COVID variant as well before we make that decision.
Well, let me drill down on that a little bit. I mean, clearly, I think I was surprised. You say you were surprised. I think most of us were surprised that coming back in September, that we didn't see more folks reenter the labor force. I believe that tapering and frankly accelerating it can kind of serve as an insurance policy if we don't see this return and we see these potential overheating of the economy. So I do hope that you will move more aggressively on this tapering. I also would like to just touch again, you mentioned some of the new variants with COVID. What factors, one of the things we've got to maintain is some ability to move quickly. And we obviously, Congress moved very quickly under President Trump and Secretary Mnuchin. With the outset of COVID, hopefully we won't have to come back to those kind of actions from this entity. But with these new variants coming on board, what are the markers you're going to look at to determine how that might influence Fed activity?
So at this point, I think we're all looking at the same thing, and we're listening to the experts, which are not. I'm certainly not one of those, but I talk to those people, and it's really about transmissibility. It's about the ability of the existing vaccines to address any new variant, and it's about the severity of the disease once it is contracted. And we don't know. I think we're going to know. What I'm told by experts is that we'll know quite a bit about those answers within about a month. We'll know something, though, within a week or 10 days. And then and only then can we make an assessment of what the impact would be on the economy. As I pointed out in my testimony, for now it's a risk. It's a risk to the baseline. It's not really baked into our forecast.
Well, down to my last 20-odd seconds, I'm not going to get away without at least raising an issue I always raise with Secretary Yellen, and I know Chairman Powell have raised with you as well. And that's, I think, the very smart action that took place, again, actually under President Trump, on investment in CDFIs and minority depository institutions. And I want to thank Chairman Brown and people like Senator Crapo and so many others, including Secretary Mnuchin, that we made that investment. And you now, Secretary Yellen, are implementing that. We've seen a great take-up rate from the ESIT program in terms of Tier 1 capital investment into these institutions that hit low and moderate income individuals. I guess with this demand way exceeding the amount of money we had, what else can we do to shore up these institutions? And I would love to press both of you. Maybe you can take this partially for the record since I've gone over on how we might even be able to look at securitization of some of this CDFI debt so that we can, again, increase the liquidity of these institutions. But if you briefly, recognizing I've gone over, answer that, I'd appreciate it. Thank you, Mr. Chairman.
Well, we would be glad to work with you to discuss possibilities there. I think that the infusion of funds into CDFIs and MDIs, it's historic. It's going to make a tremendous difference to their ability to support businesses, particularly in minority areas. We've seen huge take-up of the ESIP funds that have been provided. It's $4 billion oversubscribed. We're working through applications, and we'll try to make decisions on investments shortly, but it certainly shows that it's a program that has the potential to make an enormous difference to this lending. We would be happy to work with you to find ways to make it yet more effective.
I'm way over time. If you could just say yes, you'll work with me too, Chair Powell, that would be great.
Yes, I'll work with you too.
Senator Rounds from South Dakota is recognized for 5 minutes.
Thank you, Mr. Chairman. First of all, Chairman Powell, congratulations on your renomination. I do look forward to supporting your nomination. I think you've provided stability during a very challenging time. Secretary Yellen, it's good to see you once again, and I thank you for your service to our country. In September, when you were before this committee, I asked you when you would say enough is enough when it comes to our debt and deficit. You acknowledged that debt becomes an issue when it exceeds 100% of GDP, a level we have already hit, as you know, but said also that since the cost of servicing our debt has been negative due to a long stretch of low rates, our debt has been less burdensome. However, due to skyrocketing inflation, I think it's just a matter of time before we exit this very low interest rate environment. Do you think Secretary Yellen, do you think it's finally time to start sounding some alarm bells with regard to the financing of our national debt?
Well, I wouldn't want to sound alarm bells. I think that we are on a sustainable debt path, but President Biden was very clear when he proposed the Build Back Better plan that it should be fully financed as the infrastructure bill was. And that is what CBO found, that the fiscal plans that the Biden administration have put forth in infrastructure and Build Back Better will not worsen the debt or deficit path. And indeed, by the end of the 10-year horizon, Build Back Better lowers deficits, and it yields very great benefits beyond the 10-year horizon, particularly from the investment in the IRS to enhance its ability to close the tax gap and to collect revenues that are due under our tax code.
Right.
So it is a fiscally responsible plan that makes matters better rather than worse.
Madam Secretary, I guess the reason for my question is that it's not just a matter of whether or not we have $500 billion or so that'll have to be financed or more during a 10-year time period as that money comes back in for paying for programs that are 4 to 5 years in duration under the proposal. But rather, we have $29 trillion plus that will not only be refinanced during a time period, but may very well be refinanced at a higher rate. In fact, treasuries right now have run anywhere from 1.54 to 1.42% over the last couple of days, but they're going to trend upwards. And in fact, there are some people that would suggest that treasuries may very well hit 3.5% over the next 18 months. Do you think that would be a reasonable expectation?
The forecasts that were included most recently in the mid-session review assume that interest rates would move up over time over the 10-year horizon in line with the forecasts of blue chip and other private sector forecasters. And even then, given the expectation that real interest rates are likely to remain low, below levels that prevailed for much of the post-war period, for important structural reasons that we've seen plentiful savings at the global level and weak investment demand. Even with interest rates moving up, the interest burden of the debt remains quite manageable. Now, of course, there are scenarios in which interest rates could move up more than that, and we could be in a position, there's a chance, that the interest burden would become difficult for us to manage, but I believe we could have the capacity to make fiscal decisions.
Thank you, Madam Secretary. And Chairman Powell, I recognize, and you've been very consistent, that you manage based upon your direction, which is full unemployment and a 2% interest rate goal. But does the Fed take into account the impacts on national debt servicing and our creditworthiness when it considers interest rate decisions?
I think certainly the cost of programs, it all goes into our model. We don't really see, you mentioned credit risk. There isn't any credit risk baked into treasuries at this time, and I wouldn't expect that there would be, certainly in the foreseeable future.
When you look at this, do you project that treasuries will rise over the next 18 months?
So generally, that's something that staff has been forecasting ever since I got to the Fed 10 years ago, and it really hasn't happened. What's happened is that, as the Secretary mentioned, you have a series of long-running global forces that are leading to lower sustained interest rates. How long will they last? It's very hard to say. But for now, we have lower inflation, trend. Obviously, currently at the moment we have high inflation, but for many years we've had low inflation, and the markets are baking in a return to lower inflation.
Thank you, Mr. Chairman. Thank you for your time. Thank you for your answers.
Senator Menendez is from New Jersey is recognized.
Thank you, Mr. Chairman. One of the central pillars of the House-passed version of the Build Back Better Act is an expanded child care support program that would provide direct support to families so that nobody has to pay more than 77% of their income on high-quality child care. Madam Secretary, would expanding access to child care services improve the labor force participation rate and overall economic outcomes among women?
Senator, I believe that it will succeed in having that impact. One of the reasons that labor force participation especially of women in the United States is now lower than that in many developed countries. Once upon a time, we were the leader. Now we've fallen behind. And a major difference between the United States and other developed countries is our support for child care, paid leave, things that enable women to participate in the labor market. And so I believe the provisions, the subsidies for child care, and the universal 2 years of pre-K, both of those things, I believe, will enhance labor force participation. There are a number of studies that show that. The Treasury Office of Economic Policy recently issued a paper that summarized some of the evidence, and recently the Congressional Budget Office, in assessing Build Back Better, issued a statement that indicated that this was likely to boost labor force participation.
Well, let me. I agree. One study suggests that the rising cost of child care resulted in an estimated 13% decline in the employment of mothers with children under the age of 5. Another study found that one major city started offering 2 years of free public preschool. The percentage of mothers with young children participated in the labor force increased by 10%. So you have real-life realities of that. And one of the things that I'm looking forward to on this is the effect on minority families. A study from October in the Washington Post showed that black men and women are twice as likely as their white peers to report that they are unable to look for work because they can't find child care. So there is evidence here that the currently broken child care system is especially harmful, particularly to the most vulnerable members of our society. Chairman Powell, earlier this month I sent you a letter along with Chairman Brown and several of our Senate colleagues asking you to work closely with the Boston and Dallas Board of Directors and search committees to find and select diverse candidates for the open president's position. We haven't had Hispanic in this role. Can you give us an update on how that search is going, including what specific steps you've taken to ensure the diverse candidates are being considered?
So those searches are just getting going now. They've, I believe, both hired headhunters, and I know the process well, and it will involve extensive outreach to all different kinds of communities and an openness to different kinds of candidates. And it's essential, we believe, that diverse candidates be identified and be given every chance to do well and win those processes as they go forward. So I can take you through the details of it if you'd like offline, but it's something we're pretty committed to.
Well, I'd very much like to see that because, as you and I have discussed on several occasions, the Federal Reserve has a serious diversity problem, particularly at the leadership level. And the lack of minority representation hurts the Fed's ability to do its job, especially when we talk about promoting maximum employment and price stability. It's essential that the Fed has in place individuals that understand how an uneven recovery will impact minority communities. So I look at this as the beginning of, I hope, an effort as it relates to diversity. And I hope we will have a successful result. I understand a process that hopefully includes good qualified candidates to be considered. but I hope it will lead to a successful result. Madam Secretary, let me turn to you on the same question. How have you empowered Janice Bowdler, the Treasury's first counselor for racial equity, to diversify the Treasury Department? This is something that I think I've raised with you several times. I'd like to understand what her first goals will be. What are the immediate goals for the Council for Racial Equity? Can you speak to me to those issues?
Yes, briefly, she's empowered to review and look for ways to enhance not only our internal hiring and diversity efforts within Treasury, but also to review all of the programs that we conduct, whether it's the emergency programs that were authorized by the ARP or our tax code and the way it's administered more broadly. We've asked her to undertake a review of ways in which these programs can be changed, or they may have unintended negative consequences on diversity or on minority communities, and we're asking her to look for ways to improve what we do, both internally at Treasury and with respect to the many programs we conduct.
I look forward to seeing the effects of her work. Thank you, Mr. Chair.
Thanks, Senator. Senator Tillis is recognized from his office, perhaps. He may have turned his camera off. Senator Kennedy from Louisiana is recognized.
Madam Secretary, welcome. Mr. Chairman, welcome. Congratulations. Mr. Chairman, I want to start with you. I realize that no one is clairvoyant, but I think it's fair to say that the experts who have been advising you about the future rate of inflation have pretty much the same credibility as those late night psychic hotlines you see on TV. Is the Fed considering increasing the pace of its tapering? We've got to get control of inflation. It's ravaging our people.
So I think what we missed about inflation was we didn't predict the supply side problems, and those are highly unusual and very difficult, very nonlinear, and it's really hard to predict those things. But that's really what we missed, and that's why all of the professional forecasters had much lower inflation projections. You ask about the taper, and so yes, as I mentioned earlier, since the last meeting, we've seen basically elevated inflation pressures. We've seen very strong labor market data without any improvement in labor supply. And we've seen strong spending data too. So, and remembering that every dollar of asset purchases does increase accommodation, we now look at an economy that's very strong and inflationary pressures that are high. And that means it's appropriate, I think, for us to discuss at our next meeting, which is in a couple of weeks, whether it will be appropriate to wrap up our purchases a few months earlier, as I mentioned.
All right.
In those 2 weeks, we're going to get more data and we're going to learn more about the new variant.
Okay. Thank you, Mr. Chairman. Madam Secretary, you and I don't agree on everything, but I have great respect for your intellect and your experience. And I understand you have a job to do, but I would be remiss if I didn't point out that, in my opinion, there is no fair-minded person in the Milky Way who believes the infrastructure bill and the Build Back Better bill are not going to require the American people to incur substantial debt. Now, here's my question. And I'm looking for a number. How much, in the Biden administration's opinion, is too much debt? At what point, as you incur debt, will the Biden administration say, okay, that's it? We can't borrow any more or it's going to hurt the American people?
Well, first of all, I want to say that I disagree with your assessment of Build Back Better. It is fully paid for, or even more than fully paid for, and CBO just completed a comprehensive review of it in which they found essentially the same thing. And I believe it was important that it be fully paid for. Now, I think no single metric is appropriate for evaluating whether or not the level of debt in an economy is reasonable and sustainable. And we're accustomed to looking at debt to GDP ratios and using those kind of metrics and looking around the world. Many economists have found that debt to GDP ratios of 100 or more tend to be associated with significant problems.
Are we at 100 and more?
We are,
yeah.
But we are in very different times, and that's why it's important to recognize there's no single metric that's right. And especially in a world of very low interest rates, it's appropriate to look at the burden of that debt on society, which is better measured by the real interest burden of the debt. And that is exceptionally low, negative currently, but projected as interest rates normalize to rise to a level.
I'm going to run out of time.
It's still very
Let me
moderate.
ask you this, Madam Chair, quickly. You gave a great speech back in September of 2019. It was actually an interview, and I ordered a copy at the time. And I'm trying to find my copy here. You said, this is what you said. I'm going to quote. I thought this was such a wise statement. You said, the former Fed chair said she is not worried about the debt to gross domestic product ratio in the United States right now, but added, and I quote, I'm worried about the trajectory of where it's going. It's not stable. We're not living within our means right now. Debt's going to escalate, and that's going to create problems down the road. But then most important is the demographic wave that lies ahead of us is going to essentially, over the next 30 years, double spending on three programs: Social Security, Medicare, and Medicaid as a share of GDP. And the increases, both because of the aging population and on the healthcare side, medical expenses, those things put us on a trajectory of a completely sustainable budget path. Now, that was when the debt was $17 trillion. It's $29 trillion. You're going to add trillions more through the Build Back Better. Why is that not true today?
Well, I want to repeat again, Build Back Better is fully paid for and will not add to the debt or to deficits.
Right.
And in fact,
you and I just don't agree
reduce
on that.
it.
Understand.
CBO certainly agrees with what I said. And I mean, we do have problems eventually in financing Medicare and Social Security, which need to be addressed.
Thank you, Mr. Chairman.
Senator Van Hollen is recognized for 5 minutes from Maryland.
Thank you, Mr. Chairman. Thank both of you for your service. Chairman Powell, congratulations on your renomination. And Secretary Yellen, I really want to pick up just where you left off. I remember 3 years ago in both this committee and the Budget Committee talking about the Republican tax breaks for big corporations. At that time, the Congressional Budget Office did assess that it would add $2 trillion to the deficit. Is that not true?
That is my recollection, that was the kind of number they came
That was the CBO score.
Yes.
So it's interesting to hear so many of my colleagues who 3 years ago didn't give a damn about adding $2 trillion to the debt, now talking about the Build Back Better bill, which, as you said, doesn't add to the debt at the end of the 10 years. In fact, the Congressional Budget Office has already done its analysis. And one of the ways that it does not add to the debt is that we close some of those big tax breaks for multinational corporations who like to park their profits in tax havens. And we got rid of some of the incentives in that bill that actually encourage U.S. companies to ship jobs and equipment overseas. Isn't that the case?
That is the case.
And can you talk also about your efforts, your successful efforts to establish a sort of 15%, global minimum rate in order to prevent the race to the bottom?
Yes. Over decades, what we have seen is that countries have been engaged in a race to try to attract more multinational firms to do business in their countries by cutting corporate tax rates. And if you look at the pattern across the globe, you see that corporate tax rates have simply been trending down. The consequence of that is that corporations have paid less and less tax in the United States and elsewhere. They have won from this competition, and countries like the United States and other countries are raising less and less money through taxation on corporations. In the United States, corporate taxes have fallen to around 1% of GDP as a consequence of this. And this international tax agreement that's been endorsed by, I think, 137 countries have agreed to hold hands and say, enough is enough. We need to raise taxes to support infrastructure spending, to support investment in people, to make our economies productive, to grow over time. And corporations that are profitable and successful need to pay their fair share. So we want to be able to tax companies at a reasonable rate and to stop this race